Silver crashes 22% in 2 hours. What just occurred? 2 hours. That's all it took. $90 to 73. A 22% collapse in 120 minutes. But here's what they're not telling you. While Western markets bled, Shanghai held a $10 premium. 3 million ounces vanished from vaults days before the crash. Asahi, 2 million ounces gone. HSBC, 900,000 withdrawn. This wasn't panic. This was precision. The question isn't what happened. The question is, who knew it was coming? Welcome to Financial Crisis Explained. Now, if you've been around long enough to remember when a handshake meant something, when business was done on integrity, not algorithms, then you understand the value of straight talk. We don't dress up the truth here. We document it. So, do me a favor, hit that subscribe button. Not because everyone else is doing it, but because you've earned the right to information that respects your experience. And tell me, where are you watching this from today? New York? London? Mumbai? Singapore? Drop your city in the comments, because what happened in those 2 hours affects every single market on this planet. Now, let's examine exactly what occurred. On the night of February 4th, 2025, the global silver market experienced what analysts are now calling one of the most violent price dislocations in modern precious metals history. Between the hours of 9 p.m. and 11 p.m. Eastern Standard Time, silver prices collapsed 22% from $90 per ounce to $73. 2 hours, 2 exchanges, 2 very different stories. The Shanghai Futures Exchange recorded the initial break. Trading algorithms detected unusual volume surges at 10 a.m. Shanghai time. Within 30 minutes, the sell orders intensified. By the time Western traders were reviewing overnight activity, the damage was comprehensive. But here's where the narrative diverges from conventional market behavior. While Shanghai futures plummeted, they did not plummet alone. Western spot markets opened at $75. Western futures contracts settled at $76. The synchronization suggested coordination, not chaos. Yet Shanghai spot markets held at $86. Shanghai futures maintained $90, a $10 premium, persisting through a 22% collapse. This is not normal market behavior. In typical stress events, arbitrage mechanisms erase such differentials within minutes. High-frequency trading systems are specifically designed to exploit these gaps. The fact that a $10 premium remained stable throughout the collapse indicates something far more significant than mere volatility. It indicates segmentation. The Chinese market was not participating in the Western price discovery mechanism. It was observing it, while maintaining independent valuation. To understand the significance, one must examine the technical structure that preceded this event. For 17 consecutive trading sessions, silver had tested the $87 to $90 resistance zone. Each attempt to establish a daily close above $90 failed. Technical analysts had documented 3 distinct rejections. Each rejection formed a lower high. Each lower high suggested accumulating resistance. The pattern was methodical. The pattern was observable. The pattern was predictable. On February 3rd, silver made its final attempt. Intraday highs touched $91. Hope emerged among momentum traders that the breakout was finally materializing. But by the close of trading, $88. Another rejection. Another failure to hold above the critical threshold. 18 hours later, the collapse initiated. Gold, meanwhile, traded at $3,021 per ounce. Under normal correlation patterns, a 22% decline in silver would trigger a corresponding movement in gold. Historical data shows an average correlation coefficient of 0.7 between the two metals during stress events. Gold moved, but only fractionally. A 2% decline while silver hemorrhaged 22% represents a correlation breakdown of historic proportions. This divergence raises uncomfortable questions about what actually transpired in those 2 hours. Was this a liquidity event? A forced deleveraging? A technical breakdown that triggered cascading stop losses? Or was this something else entirely? The mechanics of the collapse reveal precision rarely seen in panic selling. The volume patterns show concentrated selling at specific price levels. $85, $80, $75. Each level absorbed massive sell orders before the next leg down initiated. Panic selling is chaotic. It lacks structure. It lacks timing. It lacks the mathematical precision observed in this event. What occurred on February 4th exhibited all 3 characteristics. Market participants with long positions experienced devastating losses. Margin calls propagated across trading desks globally. Retail investors watching their portfolios evaporate in real-time flooded forums with confusion and anger. But somewhere, someone was positioned for exactly this outcome. The Shanghai Premium tells us who. While Western holders liquidated, Eastern accumulators maintained their bids. The $10 differential represents the gap between forced sellers and strategic buyers. It represents the transfer of physical metal from weak hands to strong hands. It represents opportunity recognized by those who understood what was coming. In the precious metals market, price and value often diverge during dislocations. Price is what desperate sellers accept. Value is what informed buyers recognize. February 4th was not a collapse of value. It was a collapse of price, engineered with surgical precision and exploited by those who understood the difference. The question business leaders must now ask is not what happened, but what happens next, when physical supply has already been repositioned and price discovery mechanisms have been fundamentally compromised. 3 days before the collapse, something extraordinary happened in Lower Manhattan. The COMEX vaults, the epicenter of Western precious metals settlement, experienced the largest single-day withdrawal in over 18 months. 3 million ounces of registered silver removed. To put this in perspective, 3 million ounces represents approximately 93 metric tons of physical metal. This is not paperwork. This is not a ledger adjustment. This is actual bullion, loaded onto armored trucks and transported to undisclosed locations. The withdrawal occurred on Tuesday, February 2nd, 48 hours before the price collapsed by 22%. Coincidence is a word people use when they don't want to acknowledge patterns. Let's examine the patterns. Asahi Refining, one of the world's largest precious metals refiners, withdrew 1,950,000 ounces, nearly 2 million ounces in a single transaction. The withdrawal was processed through their registered vault facility between the hours of 2 a.m. and 6 a.m. Eastern Time. Why those hours? Because that's when scrutiny is minimal, when trading volume is light, when questions are fewer. HSBC followed 9 hours later, 914,000 ounces, removed from their designated vault in a series of coordinated transfers, the timing synchronized with London market close. The geography matters here. HSBC operates as a bridge between Eastern and Western precious metals flows. Then JP Morgan, 282,000 ounces. Smaller than the others, but significant because of the institution making the withdrawal. JP Morgan holds the largest silver position among COMEX banks. Their movements are monitored. Their actions are analyzed. Their timing is never accidental. Combined, these three institutions extracted over 3 million ounces in less than 24 hours. Now, here's what makes this genuinely alarming. COMEX operates two vault categories, eligible and registered. Eligible silver is metal stored in approved facilities, but not available for delivery against futures contracts. Registered silver is metal specifically designated for contract settlement. It is the deliverable supply. It is the backbone of price discovery. All 3 million ounces came from registered vaults. When registered inventory declines, the ratio between paper contracts and physical metal deteriorates. On February 2nd, there were approximately 400 million ounces of silver represented by open futures contracts. Registered inventory stood at roughly 60 million ounces before the withdrawals. After the withdrawals, 57 million ounces. The paper-to-physical ratio expanded from 6.7.1 to 7.1 in a single day. This is not academic theory. This is structural fragility. But the story deepens when we examine where this metal was likely redirected. Shipping manifests from Newark Port show a 43% increase in precious metals cargo bound for Rotterdam during the first week of February. Rotterdam serves as a European redistribution hub. From Rotterdam, metals flow to Switzerland for refining, and from Switzerland to Asia. Simultaneously, Chinese customs data reveals that January silver imports reached their second highest level on record. Demand from solar panel manufacturers, electronics producers, and strategic reserves has intensified throughout the fourth quarter of 2024. The timing creates a narrative: Western vaults emptying, while Eastern demand accelerates. Physical metal migrating, from seller nations to accumulator nations, price discovery mechanisms fragmenting, as deliverable supply concentrates in fewer hands. This is not speculation. This is documented supply chain behavior. What makes the February 2nd withdrawals particularly significant is their proximity to the collapse. In normal market conditions, large vault movements might precede price increases, not decreases. Declining supply typically supports higher prices, unless the withdrawals themselves were a preparation for what was coming. Consider the mechanics. If an institution knows significant selling pressure is about to hit futures markets, and they possess physical metal, the optimal strategy is clear. Remove your physical supply before the price collapses. Let paper markets absorb the selling pressure. Then, when prices have been suppressed through futures liquidation, reacquire positions at drastically lower levels. The $10 Shanghai premium validates this thesis. While Western paper markets experienced forced liquidation, Eastern physical markets maintained elevated pricing. Those who withdrew physical metal on February 2nd were not fleeing silver. They were repositioning ahead of an engineered dislocation. The vault movements were not a symptom of the collapse. They were a precursor, executed by entities who understood exactly what was about to unfold, and positioned accordingly. The question for business leaders and capital allocators is not whether manipulation occurred. The question is, who controlled the timing, and what does their positioning tell us about what comes next? There's a moment in every engineered collapse where mathematics overtakes emotion. February 4th, 11:47 p.m. Shanghai time was that moment. What appeared on trading screens as panic was actually precision. Let's deconstruct the mechanism. Silver futures contracts operate on leverage. A trader controlling $100,000 worth of silver might only post $5,000 in margin. This 20-to-1 leverage amplifies gains during rallies and obliterates accounts during collapses. When silver traded at $90, margin requirements held steady. Accounts were solvent. Positions were secure. Then, the first wave hit. $89, $88, $87, $3 decline in 11 minutes. For most traders, this was uncomfortable but manageable. Stop losses hadn't triggered yet. Margin calls hadn't materialized. The belief persisted that this was merely another test of support before the next leg higher. That belief was the trap. At $86, the algorithm changed. Sell orders didn't trickle into the market. They flooded it. 15,000 contracts dumped in 90 seconds. The order book couldn't absorb the volume. Bid levels evaporated. Market makers widened spreads. Liquidity vanished. $85 became $82 in 4 minutes. This is where the cascade mechanism activates. Traders who bought at $88 with 5% margin were now underwater. Their brokers issued margin calls. They had minutes, not hours, to deposit additional funds or face forced liquidation. Most couldn't respond fast enough. Automated systems began closing positions. These weren't discretionary sales. These were algorithmic liquidations. Thousands of contracts dumped simultaneously across multiple exchanges. Shanghai, Hong Kong, London, New York. Each liquidation triggered the next. Each forced sale pushed prices lower. Each lower price triggered additional margin calls. This is not a free market finding equilibrium. This is a controlled demolition using market structure as the explosive. By the time silver reached $80, the retail side of the market was essentially eliminated. Every leveraged long position established above $85 had been forcibly closed. The capital that had driven silver from $70 to $90 over the previous 3 weeks evaporated in less than 90 minutes. But here's what separates this event from organic selling pressure: the volume distribution. In genuine panic events, selling is continuous. Fear drives irrational behavior. Traders exit at any price. The volume chart shows steady intensity throughout the decline. February 4th showed something different. Selling occurred in distinct waves, massive volume spikes at $85, then a pause, another spike at $80, another pause, a final surge at $75. Each wave precisely targeted key technical support levels. Each pause allowed the market to absorb the sales before the next wave initiated. This pattern requires coordination. It requires capital. It requires institutions with deep enough pockets to absorb temporary losses while executing a multi-stage suppression strategy. Who possesses such capabilities? The list is short. Sovereign wealth funds, central banks, bullion banks with access to borrowed metal, hedge funds with billion-dollar risk appetites. But motive matters as much as capability. During the collapse, gold declined only 2%, platinum moved 3%, palladium remained virtually unchanged. If this were systematic deleveraging across commodities, all metals would have collapsed proportionally. They didn't. Silver was isolated. Silver was targeted. Silver was the objective. Now consider the Shanghai premium again through this lens. While Western futures markets experienced forced liquidation, Shanghai maintained $90 pricing. Chinese traders weren't selling, they were buying. The premium wasn't a glitch in price discovery, it was a statement of intent. The Western mechanism destroys price through leverage and liquidation. The Eastern mechanism accumulates physical metal at suppressed valuations. One system weaponizes paper contracts, the other system exploits the resulting dislocation. This is not conspiracy theory. This is market structure arbitrage executed at the highest level. Historical precedent validates the pattern. April 2013. Gold collapsed 12% in 2 trading sessions. Vault withdrawals preceded the decline. Eastern buying intensified during the collapse. March 2020. Silver dropped 33% in 4 days. Futures liquidation drove the decline. Physical premiums in Asia expanded to record levels. September 2022. Silver fell 18% in 3 weeks. COMEX registered inventory declined sharply beforehand. Chinese imports surged afterward. The template repeats because the mechanism works. Suppress paper prices through coordinated futures selling. Trigger margin calls and forced liquidation. Accumulate physical metal at depressed levels while Western holders capitulate. February 4th was not an anomaly. It was the most recent execution of a proven strategy. The implications for business leaders are profound. Price discovery in precious metals markets is no longer purely market-driven. It is influenced, manipulated, engineered by entities with resources that dwarf typical market participants. Understanding this reality doesn't require embracing conspiracy. It requires acknowledging capability, recognizing patterns, and adjusting strategic positioning accordingly. The mechanism has been revealed. The question is whether decision makers will recognize it before the next execution begins. Every market dislocation reveals who was prepared and who was exposed. February 4th was no exception. The question now facing business leaders, institutional allocators, and strategic planners is not what happened, but what this event signals about market structure, capital flows, and the emerging bifurcation between Eastern and Western financial systems. Let's begin with industrial consumers. Silver is not merely a monetary metal. It is an industrial necessity. Electronics manufacturing requires it. Solar panel production depends on it. Medical devices utilize it. Electric vehicle components incorporate it. A company purchasing silver at $88 per ounce in early February watched their input costs collapse to $73 within hours. On the surface, this appears advantageous. Lower costs, improved margins, enhanced competitiveness. But supply chain professionals understand the deeper implication. If prices can collapse 22% in 2 hours, they can surge 30% just as quickly. The volatility itself becomes the risk. Procurement strategies built on stable pricing assumptions disintegrate. Budget forecasts become unreliable. Long-term contracts become liabilities if locked at elevated levels, or missed opportunities if prices subsequently spike. The February 4th event forces industrial consumers to reconsider their hedging strategies entirely. Futures contracts, the traditional tool for price protection, proved useless during the collapse. Those holding long futures positions for hedging purposes experienced the same liquidation as speculators. Physical inventory becomes the only reliable hedge in dislocated markets. This realization is already manifesting in corporate behavior. German automotive manufacturers increased physical silver holdings by 18% in January. Japanese electronics conglomerates expanded warehouse capacity for precious metals storage. American solar companies negotiated direct relationships with refiners, bypassing exchange mechanisms entirely. The strategic shift is clear. Migrate from paper-based price protection to physical supply security. For institutional investors, the implications are equally profound. Portfolio theory traditionally views precious metals as uncorrelated assets, a hedge against currency debasement, a stabilizer during equity market volatility, a store of value during systemic stress. February 4th challenged every assumption. Silver collapsed while equity markets remained stable. Gold barely moved while silver hemorrhaged. The correlation breakdown suggests that precious metals no longer behave as a unified asset class during stress events. Investment committees must now distinguish between paper exposure and physical exposure. An ETF holding silver futures contracts experienced the full 22% decline. A vault holding physical allocated silver maintained intrinsic value regardless of paper market pricing. The performance divergence is forcing institutional capital to reconsider vehicle selection. Closed-end funds trading at discounts to net asset value. Physically backed trusts with segregated storage, direct ownership through secured vault facilities. Each structure provides different exposure to the paper versus physical dynamic that now dominates precious metals markets. But the most significant strategic consideration is the east-west divergence. The persistent $10 Shanghai premium is not a temporary aberration. It is a structural feature of fragmenting global markets. Chinese buyers are willing to pay $90 per ounce, while Western sellers accept $75. This spread represents more than regional demand differences. It represents capital flow direction. Western financial systems are paper-centric. Value is represented through contracts, derivatives, and electronic ledgers. Eastern systems increasingly prioritize physical settlement. Value is represented through deliverable assets, secured storage, and tangible ownership. This philosophical divergence creates arbitrage opportunities, but only for those positioned to exploit them. A strategic allocator purchasing physical silver at $75 in Western markets can theoretically sell into Chinese demand at $85. The $15 profit margin, minus logistics, insurance, and regulatory costs, still yields substantial returns. But accessing this arbitrage requires infrastructure, vault relationships, customs expertise, refining partnerships, transportation security. The barriers to entry favor institutions, not individuals. This is the emerging reality of precious metals markets, bifurcated pricing, structural advantages for large capital, disadvantages for retail participants, for those accumulating strategic reserves. February 4th presented a textbook acquisition opportunity. Physical metal available at suppressed prices while fundamentals remain intact. Industrial demand growing, monetary debasement continuing, supply constraints intensifying, but timing matters. Buying during the collapse required liquidity, conviction, and infrastructure to take physical delivery. Those who possessed all three transferred wealth from panic sellers to strategic buyers. Those who lacked any of the three watched from the sidelines, or worse, became the liquidity source for those who understood the mechanism. The surveillance framework for business leaders must now include metrics beyond price. COMEX registered inventory levels, changes in vault holdings, Shanghai premium fluctuations, refinery throughput data, import-export statistics, futures positioning reports. These indicators provide advance warning of structural stress. They reveal accumulation patterns before they manifest in price. They distinguish between genuine demand and speculative froth. February 4th was not an isolated event. It was a demonstration of capability, a proof of concept, a warning that market structure can be weaponized by those with sufficient resources and strategic patience. The business leaders who recognize this reality will adjust their capital allocation frameworks accordingly. The ones who dismiss it as conspiracy or anomaly will provide liquidity during the next execution. Markets do not exist to be fair. They exist to transfer wealth from those who do not understand them to those who do. February 4th revealed who belongs in which category. The next dislocation will confirm it. Closing. This was not entertainment, this was documentation. If you found value in this analysis, subscribe to Financial Crisis Explained, because understanding market structure is the difference between reacting to events and positioning ahead of them. Drop your thoughts below. Tell us where you're watching from. Tell us if your institution experienced this firsthand. And remember, price is what you pay during panic. Value is what you recognize when everyone else is blind.